A drop in stocks and gains in haven assets like the yen and gold, well, they're textbook knee-jerk reactions to unexpected events. But once they sit down and think more clearly, markets will need to consider long-term issues such as protectionism and inflation as potential dangers, and a pro-growth agenda as a potential benefit when they address what a Donald Trump presidency may mean. In the very short term, stock markets look set to open lower, given the uncertainty posed by an outsider candidate unexpectedly becoming America's commander-in-chief. Following on from the UK's referendum vote in June, this also reinforces the presence of political risk that's been absent from most developed markets for the thick end of 2 decades, especially as we have the Italian constitutional reform vote to come in December, and then elections in the Netherlands and France in spring 2017. All 3 countries have protest parties which are already gathering momentum. Investors will also be aware of the historical patterns, which show the Dow Jones Industrials has fallen by an average of 1.2% in the first year of a Republican president since 1945. In addition, the US benchmark has fallen on all 4 occasions in the 12 months after the White House has passed from Democratic to Republican control. One potential straw at which the markets may clutch is that the volatility could persuade a knock-kneed US Federal Reserve not to raise interest rates at its next meeting on 14th of December. The central bank has already cited financial market ructions as a reason for standing pat on more than 1 occasion this year. Now, on the plus side, markets would have usually welcomed a president whose agenda includes corporate tax cuts and a substantial, if still a bit vague, infrastructure investment programme, as both could boost the US economy, which still appears stuck at stall speed. In addition, if Trump really does try to pursue some of the more extreme policies outlined during his campaign, he's still got to get them through both the House of Representatives and the Senate. And since he's by no means a classical Republican and seems to have poor relations with House Leader Paul Ryan, any more outlandish plans could be blocked on Capitol Hill, unless of course Trump gets rid of Ryan. Now, the biggest long-term downside risk seems to me to be proposed by Trump's protectionist, even isolationist stance, and that's for 2 reasons. First, economists agree on very few things, but one point of consensus seems to be that the introduction of tariffs in the 1930s made a difficult situation an awful lot worse than it would have been otherwise. There's already clear evidence of a slowdown in international trade flows, and tariffs would be a further burden on this front. Second, tariffs and protectionism are inherently inflationary. They mean rising prices. Rolling back the disinflation prompted by 2 decades of global supply chain management could easily spook bond markets and potentially mean central banks have to take interest rates higher more quickly than expected. The Fed may therefore pause in December, but could find itself playing catch-up if Trump does impose tariffs on imports from Asia, Latin America and Europe, a prospect which is likely in itself to weigh on emerging market stocks particularly heavily today. Thank you for watching, and I look forward to seeing you next time.